Understanding market structure is a game changer for traders of all skill levels. It helps uncover the actual direction of the market, pinpoints possible reversal zones, and provides valuable insights into how price behaves. In this video, you'll learn how to interpret price action like a seasoned trader. We'll cover essential smart money principles, starting from the basics and gradually advancing, so you can accurately read market structure and determine market bias. So, if that sounds interesting to you, kindly hit the like button. Also subscribe and turn on the notification bell so you can stay updated on our latest strategies and insights. Now, let's get started. Let's begin by examining a bullish market structure. In simple terms, this means the price is climbing by consistently forming higher highs and higher lows. Now, let's break down the strong and weak areas within this setup. When the price breaks above a previous high, it signals strong buying pressure. The low that comes just before this breakout is referred to as a strong low. It's considered strong because the market showed enough force to push higher, and that low acted as a solid support where buyers stepped in. If the price retraces but fails to drop below that strong low, it indicates weak selling momentum. This failed downward attempt means the market tried to reverse but couldn't. The minor high created during this pullback is known as a weak high. It's weak because it will likely be broken if the upward trend resumes. When the price climbs again and breaks through that weak high, a new break of structure forms, creating another strong low. This is the cycle. The market moves higher, forms a strong low, pulls back without breaking it, and then pushes higher again. As this sequence repeats, the bullish trend strengthens. That's how an upward structure is built. Now let's look at a bearish structure. In a bearish market, price moves downward by consistently forming lower highs and lower lows. A break below a previous low indicates that sellers have taken control. The high formed just before that break is known as a strong high. It's labeled strong because the market reacted to that level and continued moving down from it. If price pulls back but can't rise above this strong high, it shows that buyers are losing strength. The minor low formed during this weak upward move is referred to as a weak low. This low is considered weak because the market lacked the power to reverse the downtrend. Once price breaks below that weak low, it confirms that bearish structure is still intact. A fresh move downward confirms another strong high, reinforcing the ongoing trend. This cycle keeps repeating. Price respects prior highs, fails to break them during retracements, and continues forming new lows. Every failed attempt to push higher further validates that sellers remain in control. Recognizing this pattern helps traders gauge whether the market is likely to keep declining or potentially reverse. As long as lower highs and lower lows continue to form, the downtrend remains in play. Now that we've gone over the concept of a break of structure, which signals a trend continuation, let's talk about something different. What happens when the market reverses direction? This is where the concept of change of character comes in. During a bullish trend, price makes a higher high. But if it then drops and breaks below the most recent strong low, it signals a potential trend reversal. The high that led to this break is significant because it had the strength to shift the market structure. When that low is broken, a supply zone often forms near that strong high, marking a potential turning point. The same logic applies in a bearish trend. If price breaks above the latest strong high, it may indicate a shift to the upside. This creates a strong low, and a demand zone typically forms, since breaking a major structure level often creates an opposing zone. Let's look at an example on the chart. As you can see, price is trending upward, creating a series of higher highs and higher lows. We start by identifying the lowest point on the chart as our initial strong low. Price then moves up and pulls back, but doesn't break below that strong low. The high it formed before the pullback is considered weak. Price then climbs again and breaks above that weak high, confirming the uptrend. So the low before the breakout becomes a new strong low. After a minor pullback that again doesn't break the strong low, price rises and forms a new high. This new high is labeled a weak high, and once it's broken, we get another bullish break of structure. Again, the low before this move becomes another strong low. Now let's look at an example, combining both break of structure and change of character. On this chart, starting from the left, you can see that the market was clearly forming higher highs and higher lows, indicating strong buying pressure. Early in the move, price broke above a previous week high, which indicates a bullish break of structure and suggested the uptrend was strengthening. Following that breakout, price retraced but didn't fall below the last strong low, so the high formed during this pullback was considered a weak high. When price advanced again and broke above that weak high, it confirmed another bullish break of structure, making the low before the move a new strong low. The pattern still repeated. Another pullback occurred without breaking below the recent strong low, forming yet another weak high. Then price climbed again, broke above that high, and established another strong low. Eventually, the price pushed higher one final time, forming a new strong high at the top of the trend. After reaching this peak, bullish momentum faded, and the market began to reverse. Price moved lower and eventually broke below the most recent strong low. This marked a change of character, meaning a shift in market direction, thereby making this high a strong high. The market then retraced, but couldn't break above that strong high, forming a weak low. Soon after, price dropped again and broke below the weak low, making this high a strong high. Another small pullback followed, but again failed to break the strong high, leaving another weak low in place. Finally, price continued downward, breaking that weak low and forming a fresh, strong high in the new bearish trend. This is the process used to distinguish between strong and weak structural points in the market. It helps reveal whether buyers or sellers have control and offers insights into potential trend shifts. To sum it up, market structure is all about how price behaves around highs and lows. Weak highs are those that don't lead to significant downward movement. They're typically broken easily when the market revisits them. In contrast, strong highs trigger sharp downward moves, signaling strong selling pressure, and are more likely to hold. On the other hand, weak lows are common targets where price dips below to gather liquidity before pushing higher. Strong lows, however, are created when buyers enter the market with force, causing a solid upward bounce. These levels rarely get revisited. Understanding these distinctions is key to aligning with smart money, staying on the dominant side of the market, and avoiding avoidable losses. So, if you found this video helpful, kindly hit the like button. Also subscribe and turn on the notification to stay updated with our latest videos.